Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Well, what's going on today? Today is March the 12th. It's a Thursday. What is dominating the news? Can you really guess? It's obviously COVID-19, the coronavirus. Basically, everything you read right now talks about how it's affecting people, sporting events, cultural events, financial markets, different countries, health systems, investment, the whole bit. That dominates the news. So obviously it's a concern to a lot of people. We have to look at that. The one thing I'm happy though is that we live in North America. We live in the US here. If you're in Canada, North America, whatever, we're in a stable environment with good health care and lots of control and lots of support, etc. So keep that in mind. Please don't panic. I see a lot of people panicking out there, and this is how things happen. There's a lot of news that goes a lot out there, and a lot of not fake news, but I think salacious, and sometimes things are made out to be worse than they actually are. When we start taking a look at really what's going on, maybe you might feel a little better with respect to the truth. And again, just do your due diligence, figure stuff out. And not that I'm not downplaying this, but again, I'm not personally in a panic mode as of yet. All right, so but this is driving an economic downturn. There's no doubt about it. We're seeing airline travels slow down. We're seeing sporting events being canceled or being shut down, and things are changing. So we have to think about how it's going to affect the trickle-down effect of all these things as time goes on. So there's a gentleman I know. He's a Central Florida real estate broker here. He's also a real estate investor. He's widely known in our area, being very astute financially, very nice man. And I'm going to quote his Facebook post. I'm not going to tell you who he is because I don't have permission to actually do that. I'll just read a snippet. Basically, he's saying, history favors the bold. So here are a few of his thoughts from right now on how to make lemonade out of lemons in this economic downturn. Study cruise lines, airlines, hotels, and those companies most adversely affected. Sell your losers now if you have stocks for tax loss, but then buy the most adversely affected. So the ones that are going to drop and dip are the best ones to buy because they're going to ramp up afterwards. Forget about it for a few years. You'll thank yourself down the road. Refinance everything, not just your mortgages. Look at redoing your car payments with local lenders and credit unions. Rates have never been this low. It's kind of nuts out there. Buy real estate rentals, and that's a key point here, and lock in a crazy low rate. Assuming it meets, the usual 1% rule. Like you want 1% of the purchase price to, that's kind of a rule. Like if you bought it for $100,000, then hopefully you're going to get at least $1,000 a month in rent. That kind of 1% rule is what you're looking at, and that way you're at least in good shape. As a side note, I was up till 11 o'clock last night, going through deals, talking to people. There is major movement going on in the marketplace right now. We literally were engaging a local person here who has access to 150 rental properties in the greater Tampa Bay area, and we're looking at moving a lot of those. So if that's interesting to you, reach out to me via email and put your phone number in there. Let's talk, because this is what's happening now. I see a lot of market movement. The opportunity is, guess what? These are all below market rent. So if people have been renting for a while, typically they haven't moved their rents up. It's a chance to acquire, to maybe refresh the unit, either raise rents or remove tenants and put in higher paying tenants, and you got a better return on your cash. So that's every so often this happens. This is the time where it's going on right now. There's this and many more things I got on the go. So please reach out to me. Some of you already have, and we're starting to show you guys deals. So please reach out. All right. Basically, that's just I'm not going to get into too more depth of what he said, but this is a guy who runs 4 or 5 brokerage firms, does a lot of deals personally, buys at the auction, buys real estate, investing the whole bit. So he knows what he's talking about, and that's just his kind of advice. All right, let's talk about what's happening in the marketplace here. And by the way, if you're not already a subscriber, please do me a favor, help my channel grow, and click the subscribe button on the bottom right of the video. I would certainly appreciate that. Thank you. All right, mortgage applications. This is what's going on right now. So rates are at all-time lows. So refinance. People are saying refinance. Well, MBA, which is Mortgage Bankers Association, doubles hits 2020 refinance origination forecast. So obviously, like every business or group, you plan, you look at your forecast for the upcoming year. So they basically doubled their refinance activity forecast for this year. So basically, mortgage applications increased 55.4% from the previous week, according to the Mortgage Bankers Association, for the week ending March the 6th. So they were up big time. And what this really means is the fact that The volume increased 55.4% on a seasonally adjusted basis from 1 week earlier, and it's the highest level since April 2009. So there you go. So really, I kind of look at 2008-9 as we're hitting down, people trying to refinance, buy hot property, whatever, as it's crashing. That's kind of your last little situation, and then it all goes to pot. The refinance index increased 79% from the previous week, also a highest level since April 2009. And it was 479% higher than the same week 1 year ago. So rates a year ago, a little high. Rates this week, now very, very low, and therefore, big time increase. All right. The purchase index only increased 6%. So when you got the refi increase in 79% and the purchase only go up to 6%, you can see what people are doing. They're not buying homes. They're looking to refi, either rate and term or taking money out because we have such great low interest rates. So that's interesting. The purchase index increased 7% compared to the previous week and was 12% higher than the same week same week a year ago. So slightly uptick in purchase applications, but when you compare with respect to refis blow it out of the water. As simple as that. And as I mentioned, MBA is doubling down on its refinance originations forecast, a 37% increase from 2019. So it's looking at least 1.2 trillion in refis this year. That's a 37% increase from 2019. And again, the strongest refinance volume since 2012. So where we are today, we're hitting all these sort of records in volume applications, comparatively speaking, to the last sort of housing crisis, Great Recession, etc. So something to keep in mind. All right, there you go. Now, of course, when rates drop, we hear from various industry analysts and statistic companies out there that more people have the ability to refinance. And there's usually a calculation. They typically say, if you have greater than, if 20% equity in your property, you can refi. So basically what we got here is the average rate of a 30-year fixed mortgage fell to a record low 3.29%. Freddie Mac reported this week. That's down from a previous low of 3.31 in November 2012. Nearly 13 million borrowers can now save money by refinancing their home loans and lowering their current rates by 75 basis points, according to Black Knight Financial, a mortgage and data and analytics company. So that's huge. So it was about 11 and change a few weeks ago. This is a record number of potential refinance candidates. It's also an increase of 1.7 million eligible borrowers in just 1 week alone. So remember, about a week ago, it was 11 million plus, could refinance. Now we're at 13 million. So literally within 1 week, that available refi pool of borrowers increased 1.7 million, which I think is pretty wild out there. So what are people going to do? Are they going to take advantage of it? Why not? I mean, if you've got the opportunity, a lot of times you can roll in your closing costs. It doesn't cost you much. So that's what the public is doing. I'm not suggesting to do anything. I'm just giving you the news. If it makes sense for you and you can reduce your payments, why not? You can take your cash out, use that cash for investments or other interesting things. Why not do that? You got great rates working for you right now. Okay, now with every reaction, there's an equal and opposite action. There's an equal and opposite reaction. So this article says homeowners are biting off more than they can chew with respect to what they're buying and what they're mortgaging. So a new survey from Bankrate found that 77% of homeowners said their mortgage negatively impacts their ability to save money for retirement. This also includes 31% who say their mortgage has a major negative impact on their ability to save, and 46% who say has a minor negative impact. So big mortgage payments have taken a bite out of your monthly income, but are also major obstacles for saving for retirement, emergencies, and other financial goals, said the CFA of Bankrate, this is chief financial analyst. He said home buyers are biting off more than they can chew or comfortably chew, making it difficult to save. And Bankrate states that 39% of homeowners have more equity in their homes than money in their retirement accounts. And, what they're saying is young homeowners are impacted the most. 78% of respondents between the ages of 24 and 39 reported a negative impact of 82%. So that's the scoop. So this is, we know that prices have risen the past few years, and that, with lower interest rates and also, I guess you say, not weakened, but relaxed, we'll call it applications and relaxed lending standards, we're allowed to have a higher debt to income ratio. So we're allowed to bring less money down as a down payment. So all these things are affecting your mortgage payment, making that large, which means the rest of your life is impacted. So if there's a change in the marketplace, what's going to happen? If you have an emergency, do you have the funds for it? And this is, again, my point always is, the less equity you have in your house, the lower down payment, the higher mortgage rate, or the higher the payment, really puts you in a precarious spot, because when something occurs and there's just maybe a 10% swing in, say, home values, which doesn't really seem like that much if you think about it, you could possibly be underwater. If you put 3% down and you've bought a home, you've only put 3% down, well, guess what? When you go to sell your home, traditionally in the open market, you're going to pay about 6% real estate commissions. If you're using a listing agent, a buyer agent comes in to bring a buyer. You've also got 2 to 3% in closing costs. So guess what? You're already negative just on that aspect, let alone if there's value decreases as well too. So this is, again, it's just noted that more and more people are, I don't know whether you'd call this buyer remorse or whatever, but they're just saying that they probably didn't anticipate the impact it would have on their finances after the euphoria of buying their property has taken place. There you go. Okay, coronavirus looms over crucial spring season for housing market. So National Association of Realtors, otherwise known as NAR, had anticipated about 5.5 million sales of previously owned homes for 2020. That's up from 5.3 million in 2019. Now, according to the chief economist for NAR, Lawrence Yun, I thought that there would be a steady increase from January pretty much throughout most of the year. Obviously, we hit a major speed bump. The association said it expected a 10% near-term drop in home sales in the next month compared with the period before the virus became prominent. In a survey of its members about the coronavirus, the association said 11% of respondents reported lower home buyer traffic, which is kind of obvious, and reported lower home seller traffic. So ultimately, in the end, when something like this happens, what do? Is we do nothing. We wait to see how it all hashes out. So if you got your home on the market, there's a couple of things. You might want to take it off and do it a bit later, or reduce price because it's going to be sitting for a while. We don't have the buy traffic. They're also saying that foot traffic for open houses is definitely down. There are also sellers who are saying to their agents, hey, cancel my open house. We don't want a parade of strangers in our homes who could be carrying viruses or the flu, whatever, because people come in, they touch handrails, doors, countertops, whatever. So you've kind of got it from the buyer side. You're going to see a slowdown in just attending these open house events and looking at properties. And the seller side, they're probably going to say, as I said, they're saying, let's not hold these open houses. Maybe let's maybe defer or wait a bit. So this is what's going on out there. In February, the number of homes for sale fell by more than 20% in half the nation's 50 biggest metro locations. And so that's kind of the scoop. So we're seeing less people putting stuff on the marketplace. That's just the way it goes, guys. All right. So again, going back to where I see from the investment side and the off-market side, where I see an increase in activity, which is where the opportunity is. So we're hearing, as I said, lots of just different interpretations as to how this virus is affecting people and the marketplace. So excuse me. And the pollen is affecting me, as I say all the time here. So it says COVID-19 comes at a time of contraction after years of frantic expansion. With an economy on a slowing trajectory, job creation, GDP, and consumer confidence are all decelerating. But we're still at strong levels, but they're actually slowing down and decelerating here. The coronavirus also hits a housing market operating at post-peak after record-level home sales and prices, but now struggling to rebuild supply amidst years of insatiable demand. Basically, through the lens of the last outbreak, the prevailing coronavirus has the potential to accelerate economic corrections and, with some lag, contribute to sharper but temporary drags on housing activity. So there you go. So we could see certainly something slow down in the housing market and some drag and probably price declines to compensate for that the next little while. What they're also saying that the Wall Street Journal reports that it's not just on housing, but it's other segments in the real estate marketplace that are going to be affected by this. So business and commercial. So hotel owners are having a hard time because clearly with the lack of travel, they're seeing people not showing up anymore. So they're going to have empty rooms every month. And especially the hotels with high debt loads are going to be grappling with a hard time to make ends meet and service that debt. So basically, they're already seeing a potential uptick in defaults and mortgage debt. Again, everything is debt. So there's a lot of mortgage debt out there on commercial property. And if income doesn't come in expectation is slowdowns will occur and defaulting on large loans for office buildings, developments, hotels, things like that will be expected, which will permeate throughout the industry. Local economies will be affected as well too. And when you take a look at, each city that, across the nation has an economy, has either some sort of manufacturing or product and service or natural resource that it cultivates or operates, etc., that drives the local economy. So, the supply chain factor could have an issue here with people, and slowdowns, which could lead to wage loss, job loss, economic depression, and or recession in local economies. They cite here Houston, for example. The Houston Chronicle in Texas said stock plunged around the world Monday in a wave of panic and selling that set markets to their worst day in at least half a decade. Houston's getting battered on all sides. The region, because of strong ties to international commerce, is more exposed to global market turbulence and oil prices than other areas of the country, combined with a sustained drop in oil prices, wide-ranging economic impacts of COVID-19, the disease caused by the new coronavirus, could very likely wipe out all the job gains and growth that Houston's had this past year, and in the worst case, could push the local economy into a recession. Well, I can tell you that I already know that a location like Houston, who got hit a few years ago by a hurricane that had a lot of flooding, had a lot of surge and defaulted and pre-foreclosure / foreclosure homes, and people were having a tough time because that's what happened after a natural disaster. When you add stuff like this on it, sometimes just compounds the issues and it slows down the recovery, which could put people in poor situations. So this is what will happen in various parts of the country. So they say it could accelerate local recessions, and ultimately, like everything's a trickle-down effect. Does this mean we're going to have 10,000 foreclosures in Houston tomorrow? Probably not, but it's going to have a trickle-down effect that will, start happening in the next few months. If people can't, are losing jobs, are not making income, or things are slowing down, companies are going to have to react to that. It's going to trickle down to employees and personal finances, which eventually trickles down to your housing payments, rent and or mortgages trickle down. So, it's tough to predict this, but whenever you see these type of things, again, usually a few months or a year down the road, we see the result of what happened earlier. So just something to keep in mind. Now, with respect to what I said earlier, we live in North America. We live in a situation where you have, a government that functions, just tongue in cheek, I'll say that. But, really, compared to other countries, we're doing okay. You've got, facilities. You've got a lot of smart people here. You've got a large economy. You've got a great health, hospitals, whatever. So we're looked at as a stable environment compared to many other countries who are certainly having it worse off if you start looking around the news. So what I think is notable here is that foreign investors are piling into the U.S. real estate play as a coronavirus safe haven. So what's been noticed here, and again, I don't know that we have the statistics to back up at this point in time on what I'm going to call pure sales, but what's been noted here is that in the past few weeks, Roofstock, a rental property sales website, has seen their traffic jump up exponentially. So their sales from the sales website has seen traffic from investors in Asia on their site jump 500%, and it's a direct result of the coronavirus. So if you're in a country that has a lot of the coronavirus and the fallout from that, there's going to be economic instability, and investors are going to look to not put their money there and park it, but move it someplace else more stable. So they're looking at the U.S. market, and particularly the U.S. housing market, as a form of stability. So I think it may be people looking to invest capital into what may be perceived as more stable areas that don't have as much of an effect, at least not from the virus, said the CEO of Roofstock. Roofstock noted a 450% jump in traffic on its site from investors in Germany, a 250% surge in traffic from Australia, and a 100% increase from the United Kingdom. So that's typically what happens, is that people who are going, okay, well, we're not happy with what's happening in our own location, our own country. I want to invest my money in something more stable. So we all know real estate is more stable in a lot of different, than a lot of different other investments, and especially down here where, not down here, but in the U.S. where we're still in a growth market, and specifically in different states across the U.S. where there's better uptick with respect to, property value stability or increasing, and rental rates and the rental cash flow increases as well too. So I just find this interesting because, I felt that in some countries there was less investment going on, more for political and economic reasons of those countries, as opposed to just the opportunity here in the U.S. Now we see that, and again, let's caveat this, foreign investors are piling into the U.S. real estate play. Well, that's, looking on a website does not equate to a closed sale, but it's a leading indicator that there's a lot of potential activity that's going to come our way, and that's just going to fuel more of the opportunity here in real estate. So investors are looking for the calm in the coronavirus storm, and the U.S. residential real estate market appears to be it, specifically single-family rental homes. These investors are not, however, coming to the U.S. to tour the homes themselves. They're buying them online, and this is the unique thing. So clearly, with respect to open houses and you looking for your home, your primary residence, whatever, that's pulled back because of the lack of, I don't want to go out in the public, or I want to maintain, my self-quarantine, etc. What we're seeing, though, is that people who are investing, they can very easily just click and go, okay, well, I can buy it for this. I can, do my analysis. I mean, you can do everything online. You can, if you have the software and the tools and the information, you can look at the properties, you can look at the pictures, the virtual tours, you can look at the marketplace, you can do your rental comparable analysis, your after repair values, your current market values. You can take a look at rent rates. You can buy through these companies. You can get property management companies to do all the work for you. So you can literally point and click from the in your pajamas at your kitchen table, if you so choose to want to invest this way. And what that's doing is allowing people to still invest, but not have to travel and be exposed to any perceived inconvenience or risk with the traveling at this time. So I just think this is interesting. And again, we are creatures of habits. The more these sites deploy and the more apps that are out there, more people will use them. You'll see less and less foot traffic at homes. A lot of it will be based on, let's just point and click, and we'll buy because it looks like a good deal. And that's how a lot of this is actually happening right now. So I just find that's kind of interesting, and we should sort of keep this in mind as to what is happening in the marketplace. And how this is going to impact us. Well, the U.S. housing market had already been in a midst of a severe housing shortage. This increase in demand just heightens the competition. So that's, again, but my point that when people are pressing things online, they're looking at typically websites that are on market properties. What they're missing is the off-market stuff, which is really booming now, and that's what you want to contact me about. All right, we're not, you're not competing with as many people, and it's stuff. It's behind the scenes stuff. People who are selling their properties, groups who are selling their properties, and they don't want to put it on the market because they don't want to deal with the retail marketplace. They want to deal with the subset of that. Okay. All right, last little bit here. Earning expectations. This is more financial. As I always mention, I don't really comment on financial markets, repo market, things like that. Obviously, I look at it, and we know there's more. The Fed's put a lot of money, liquid money into the market the past few weeks. It's out of control. Stocks are down, indices are down the whole bit. Earning expectations are starting to plunge. So I read this article today, and I look at certain sectors which impact real estate. So certainly says here, while investors are shocked, I tell you, at the plunge in U.S. stocks, they shouldn't be. Earning expectations were already plunging long before the actual indices woke up to reflect this new reality. And if I go to the little chart here, clearly, that when you look at the top sectors that have had earnings, again, I guess, you could say revisions to their to their 2020, revisions to first quarter 2020 earnings. The automobile industry, 31% decline. Oil and gas, 23%. Hotels, restaurants, and leisure, 17%. Construction engineering, down 14%. Building products, down 13%. So, that what we're going to see is, again, that's all about how it all works, right? Less foot traffic, right? So less foot traffic means less sales, which means less homes being sold from builders, which means less existing homes being sold by sellers, which means when you buy a house, you're not buying a lawnmower and buying decorations and doing landscaping and getting other products and services for your home. So all these things, you have a trickle-down effect, and whether you're not remodeling potentially, you're not doing all these. So it just shows that where we are today, there's the industries suffer and have slowdowns that sort of permeate as time goes on. So you would never think that, okay, like I never thought of this until I started really analyzing the marketplace, going, hey, when there's a housing slowdown, when I go to Home Depot, there's less people there, okay? Or so it's all proportional, to what's going on in the economy. So that's the scoop, guys. So that's it for today. I just want to touch base, on mortgage rates and sort of what's happening. I do think it's interesting that, rates are very low. People aren't going out to see properties. Investors are picking up their opportunity and looking at the U.S. as a safe haven for their money. As I mentioned, I'm getting a lot of activity and seeing a lot of property now. So if it's something you want to get involved with, give me a shout. Also with my training courses, it's starting, guys. This is, it's kind of been waiting. And this, I don't know whether this is the black swan event that people like to talk about, but certainly this is going to start some sort of process decline, as I always say, trickle down effect, that will certainly impact the housing market, and that how it's going to affect it will be determined, but got to keep an eye on it. Now's the time to learn about what could happen and how you can participate in it, because as the person I know, like quoted in the beginning, in a situation like this, is you make your money when you buy down here as opposed to buying up here, and so this is where you want to play, and we're sort of maybe starting to head down that path right now. All right, guys, thank you for the likes, the views, the comments. Look forward to talking to you maybe early next week.